I'm Stacey Bishop. For the last 28 years, I've been working in and around banking sales, credit union sales, from just about every angle you can imagine. What I help fintech founders do today is pretty simple to say, harder to execute. But I help you spot real urgency inside banks and credit unions and avoid spending months chasing deals that were never going to close. Because we all know intellectually that activity is not the same thing as progress. However, it's easy to confuse the two. We also intellectually know that interest is not the same thing as urgency. And today I want to walk you through five very specific ways to tell when a bank or credit union employee is actually motivated to move versus when they're just being polite or curious or buying time. If you catch even one of these signals early, it can save you a lot of calendar space, a lot of emotional energy, and honestly, a lot of founder frustration. And just so you know, if anything I say today feels uncomfortably familiar, I've built a fintech sales diagnostic that helps you pinpoint exactly where your deals are stalling and why. So keep that in the back of your mind as we go. All right, point number one. Can the banker clearly articulate their current state and their desired future state? That's what you need to know to understand if there's urgency. Because here's what I've learned the hard way. If a bank or credit union can't clearly describe where they are today and where they're trying to go, there's no urgency. There's just noise, there's wishes, there's grand ambitions. True urgency shows up when multiple stakeholders can say, in their own words, this is what's broken today. And this is what success needs to look like. And this gap, it's costing us something. What I see fintech sellers get wrong here is assuming that frustration with the status quo equals readiness. And it seems like it should, but it doesn't. I have a real story for you here. Years ago, I spent time with a loan operations leader who was just incredibly frustrated with the manual covenant tracking process. They had spreadsheets everywhere within their computer. They were spending late nights once a month, and they had real pain around this whole process of covenant tracking. And while that conversation was enlightening, it was fun to have, it didn't lead to a purchase. It was good for her in the long run. It led her to getting a raise because when she voiced these concerns, she received recognition, not transformation for her role or for the organization. And once those conversations happened, the urgency disappeared once she received that raise. And I see the same thing when banks talk about attracting younger customers or modernizing the experience. It sounds promising until the conversation turns towards actual numbers, lost deposits, customer attrition, revenue that's at risk of leaking out of the bank. And suddenly, the discomfort of seeing the problem outweighs the desire to fix it. So that's a stall, not urgency. So if this feels familiar and you're trying to figure out what do I do about it, the fintech sales diagnostic I mentioned is going to help you see whether your deals are stuck in just this venting mode or actually moving toward action. Let's move on to point number two. I want to ask you, is there a real event forcing a decision? Because urgency in banks and credit unions comes from not internal enthusiasm alone. It comes from a forcing function, things like mergers and acquisition activity, regulatory deadlines, contract expirations, and that's another good one. Things that will actually cause a situation to change. Leadership changes can also be a situation that might force some sort of urgency alongside strategic mandates from the board. That's something else that I've ran into in my past. That these moments tend to compress timelines, whether anyone likes it or not. Where fintechs tend to sometimes get tripped up is confusing stated timelines like the end of Q2, it has to be done with real deadlines. Because a banker saying, we'd like to have something in place by Q2 is not the same thing as a regulatory exam or merger integration plan that demands some sort of decision. And I've seen M&A completely freeze deals where everything stops while two institutions are trying to figure out the go forward path. But I've also seen those same moments create massive opportunity for fintech vendors and solution providers. If your solution helps reduce redundancy, streamline integration, stabilize risk during transition, urgency doesn't disappear. It truly intensifies in these situations. The difference is whether you're aligned to the moment that the bankers and the credit union employees are actually living it. The third point I want to share with you around urgency and the question you should ask: is there a senior level champion who can move resources, not just this enthusiasm for your project? Because titles are misleading in banking. I've seen VPs with real power, and I've seen C-level titles who didn't have the ability to move a budget line without 3 committee meetings and just a prayer. Real urgency shows up when someone with authority is willing to put political capital behind an initiative. Somebody that's comfortable pulling other stakeholders into the room and prepared to defend the project internally. One example that still sticks with me as I think back to my time on the road, I spoke with a banker in Georgia who was just deeply passionate about launching a data warehouse initiative. This individual smart, they were motivated. He reported directly to the chief operations officer. But he was alone in this impression of data warehouse being the savior to so many of the institution's challenges. And this individual didn't have cross functional support. There was no executive sponsorship behind his immediate manager. There was no urgency outside of his own interests. And it's not shocking, but the project stalled, not because it wasn't valuable, but because no one outside of him, no one with real authority was willing to carry it across the organization. And I look back on that and I would say that he was the right champion, but he was the wrong one to bank on entirely. And that was a challenge for us. And if that's ever happened to you, I suggest that you can pressure test this champions before you overcommit with the diagnostic tool I mentioned earlier. And the fourth point I'd like you to just keep in mind is whether cadence speeds up with interest or whether this is something you're trying to push along, because one is very subtle but incredibly reliable. In a normal bank sales cycle, meetings are spaced out 2 weeks, 3 weeks, maybe once a month, sometimes longer. But when there's urgency present, that rhythm, that meeting cadence, the time between steps compresses, it just changes. Meetings get scheduled faster, more people start joining these meetings. And most of the time, when there's real urgency and interest, you're no longer the one driving the follow ups and the requests for meetings. What I see fintechs misread, however, along these lines is politeness. If you, as the fintech, are the one suggesting to move faster and the banker agrees time and time again, that is polite cooperation. If the banker is the one that asks to accelerate the meeting cadence or add stakeholders or shorten timelines, folks, that's urgency. Now, one quick gut check I see is really who's setting the pace right now, because urgency does have a voice. It's not a subtle voice. And once you know how to listen for it, you will be able to detect it. Now, the fifth and final point that I want us to keep in mind here about how to you identify urgency is this one. How early are contracts being discussed in your sales cycle? Are they at the end, the logical conclusion, or are they being backed up into earlier parts of the process? Because when a banker asks to review your MSA or SNW, your exhibits, your legal language, earlier than you anticipated, that is something to pay attention to because it's more than paperwork or curiosity. That's preparation. That is these bankers wanting to get this in the hands of their outside counsel. That's excitement. That's urgency. So, especially if bankers are looping in legal proactively, if they are giving you visibility into their availability, their legal counsel's availability, their review timelines, and if they're asking questions that signal to you they're interested in implementation, not just the evaluation of your solution, you've got something around urgency that you want to pay attention to. And this is something that too many fintech sellers, myself included in my past, where we treat contracts as that final step. Because early legal engagement is often a sign that your deal is being taken seriously. And it's not a process we always have to follow linearly. But don't rush it. Just don't ignore it either. So, this is not a task for you to try to get legal agreements introduced sooner. It's a signal for you to pay attention to. All right. I want to thank you for spending this time with me. If nothing else, I hope this helps you stop mistaking motion or momentum and start qualifying urgency with more confidence. And if you want help diagnosing where your current deals are actually stalling, that fintech sales diagnostic I mentioned to you, it's designed to do exactly that, not to push you to sell harder, just to sell smarter. Because really, at banking sales, the only game you need to be playing is the long game, and you have to play it intentionally.